Hello, you're listening to the Analysys Mason podcast with Tom Rebeck. I'm joined by Michela Venturelli, who leads our research on operator spending, and Harmeet Channa, one of our consulting partners. On this podcast, we're going to be talking about the B2B divisions of operators and how they are or how they should be measured. So first, let me turn to you, Michela, because the idea for this podcast came from a piece of research that you published a couple of weeks ago, looking at different divisions in operators and the EBITDA margins of those different divisions. So if you could just describe what you did and what some of the main findings were.
Yes. So, first of all, thank you for having me, Tom. And yes, I started looking into the topic you just mentioned when I was trying to understand how profitable different telecom operators really are. So I started looking at both financial and operating metrics, at data like revenue per employee, EBITDA per employee, and that's kind of data. And so I went through that. While I was going through that exercise, I noticed that on average, the EBITDA margins of business divisions were consistently lower than those of consumer divisions. And that observation is really what sparked a deeper question around why that's the case and what it actually means for operators. So I analyzed 5 major European incumbent operators that have consistently published detailed financial and operational data for their business units in the last 6 years, so since roughly 2020. And I use this data to compare the financial performance of operators' business and consumer units to start with. And the analysis revealed that EBITDA per employee in business unit was lower than that in consumer divisions. And also that the EBITDA per employee in business division has been decreasing since 2021. Conversely, in consumer units, EBITDA per employee has been increasing over the same amount of time. What I also noticed is that for 3 out of 5 of the operator analyzed, EBITDA margins are lower in the business division than that at the group level and in the consumer divisions. Just to give you a numerical example, business division for the 5 operator analyzed reported on average EBITDA margin of 29% in 2024, and notably lower than the 48% margin in the consumer divisions. And so we just ask ourselves what this disparity means and what this gap means in terms of profitability.
Yeah. So what does it mean? Why is this a problem if they have EBITDA margins lower in the business division? Yeah.
What we notice is that the disparity can be partly explained. It's not much a reflection of difference of profitability. It much more highlights a deep difference in the structure of this business unit. It can partly explained by the broader service portfolio offered by business division and also by the shift towards services and products that actually generate less EBITDA margin. So traditional indicators such as EBITDA become less effective for comparing units that offer fundamentally different type of services, especially as telecom operators diversify into, for example, IT services, which naturally deliver lower margin EBITDA than more traditional connectivity services. Therefore, operators should expect and even embrace a lower EBITDA margin because of growing IT-based revenue. So as I already mentioned, the divergence between this type of metric in the consumer and the business unit really highlights differences between the consumer unit, which is a well-established, mature, working upon a well-known recurring revenue model, versus the business unit, which are resembling more and more consulting companies, which are delivering services which are more tailored and are becoming more labor intensive. So this basically is reflected in a cost structure which is completely different among the 2 units.
Yeah. I mean, I think this gets to the heart of the matter that for telecoms operators that are very focused on EBITDA margins, then it makes it hard for them to get more into B2B services, IT services, managed services, and so on, because inevitably that's going to drag down that EBITDA margin, even if on other measures it looks more profitable and a good way of getting growth. Because part of the paradox, I think lots of operators around the world, but particularly in Europe, are looking to B2B divisions as a way of driving revenue growth because they can see what's happening in the core consumer market. But the more they go into B2B services, like you say, IT or managed services, the more that's going to drag down EBITDA. Even if on other metrics, and we'll come to Harmeet in a minute, or what those other metrics could be, even if on those other metrics it could be more more profitable. I mean, I think this all links quite neatly to the Comcast business event that I went to a couple of weeks ago. I've also published something on that. I'll put links to both of those articles in the notes. But this really kind of exemplifies the challenge. Comcast business is doing very well in terms of revenue growth. It grew 5.5% last year, which is good by international standards, but particularly compared to the other US operators, it grew faster than any of the other big US operators for its B2B division. But they were talking a lot about where their future revenue growth will come from. And again, like you mentioned, Michaela, it's all from IT services, managed services, security, things like that. And inevitably that's going to hit their margins. And so there's this balance between growth and EBITDA margins. And that's, I think, particularly a problem for Comcast because it is very much focused on EBITDA. So I looked at their Q4 results, the transcript for that, and they talked about EBITDA. They mentioned EBITDA more times than they mentioned revenue. So that gives you some sense of how important EBITDA is for them. The other complication, I think, for the business division, for Comcast Business, is that out of the Comcast universe, it's a relatively small division. It's about 10% of their revenue, more or less. And Comcast, it's a fairly complicated operator because it's got telecoms bits, but it's also got theme parks and studios and all sorts of things in there. But because Comcast Business is only 10% of the overall revenue, it can't really dictate what metrics they should be measured on, how the financial analysts should look at the whole company. I mean, but again, it goes back to this underlying issues. What could be good on some financial metrics for Comcast Business is going to look bad on the EBITDA, and if they're obsessed with EBITDA, that's going to be a challenge. Michaela, maybe just briefly then, there were 3 points that you mentioned at the end of your piece, those 3 recommendations. Do you want to go just mention those? I think it's about transparency, communication with investors, and different metrics.
Yeah, exactly. Firstly, improving the transparency of the financial reporting will really give us analysts better tools to actually understanding the profitability of each of their units, and also perhaps fight one of the major problems of the high-level EBITDA, which is sometimes a lower group EBITDA, which is dragged down by just a business unit that has got naturally a lower EBITDA, can mask also the profit and the progress made in other unit, for example, throughout automation or just so we will be able, us as the analyst community, to better understand a bit what's going on across the organization. Secondly, they should indeed communicate this also to the investors, because at times this attachment to the EBITDA margin really could prevent operator to invest more into new innovative services, which can perhaps in the long term drive growth in the organization, but maybe have a negative impact on EBITDA, but it's not really negative actually. And finally, yes, just find new metrics that better represent profitability, growth, the trajectory of a certain unit, and that communicate this in their financial very, very, very clearly.
Great. Thanks, Michaela. At this point, Harmeet, you've been sitting there patiently, but I think it's a good time to bring you in and just to talk a bit about what could those different metrics be? What should the measures be for different parts of the telecoms operator business, but in particular for business divisions? And what are the advantages, disadvantages of those different measures, those different options?
Yeah, absolutely. And I think at this stage, maybe before getting into it, it's worth just setting out the importance of EBITDA and what it's meant for telecoms operators for a long time. So EBITDA has historically been one of the most important financial measures for telecoms operators to report on. Fundamentally, it's how a lot of telecoms operators are valued on public markets. They're often valued as a multiple of EBITDA. And beyond that, it's often a good proxy for their cash generation capabilities following periods of quite intense capital investment, which has been their bread and butter, rolling out and deploying networks and network infrastructure over a long period of time. And again, just kind of taking a step back and trying to understand what really drives shareholder value and the market cap of some of these telco operators. Fundamentally, it's that cash generation capability and the ability to pay dividends. And that's really what's mattered. Often there hasn't been too much growth from a kind of share price perspective. The value's been maintained and held through the ability to pay dividends and generate cash. I think that's a really important start point. But I think what that has also meant on the downside, albeit it was a very sensible metric for a long time period, is as they try and move into new areas, it starts to skew some of their own objectives and also maybe skew perceptions of them in the market. And I think fundamentally that's why maybe a slightly new or fresh approach to assessing some of these businesses could be quite important going forward. If I maybe just start to talk about what some of those other metrics might look like. As Michaela points out, as a lot of these telco operators move into IT services or other services beyond kind of core infrastructure, they often come with lower EBITDA margins. So from a margin perspective, it could be dilutive to the overall group, but it still adds potentially a huge amount of value just in terms of absolute EBITDA and cash generation capabilities to that group. So maybe a slightly different approach would be to consider metrics like return on capital employed. So looking at the overall profit generation over the capital that you're employing as a business to understand whether you are meeting or exceeding your cost of capital. That seems to be, a sensible way of looking at the real return you're getting on invested capital or deployed capital across your operator group. And so that's one example. And then the other example, which I'll quickly touch on, is also just the ability to generate free cash flow. So actually, fundamentally speaking, regardless of how you structure your P&L or how you account for OPEX, CAPEX, and everything in between, just how much cash are you actually generating as a business and how is that evolving over time seems like another sensible way to assess the success or otherwise of some of these different ventures that telco operators are getting into.
And what about the downsides of these measures? So maybe starting with return on capital employed.
Yeah, so I think there are a few things. So often what we find with telecoms operators is their balance sheets aren't necessarily representative of their true underlying asset value and capital that they have deployed. So typically, telco operators' balance sheet is very much a function of some accounting rules that they set up potentially many, many years ago. And actually, the assets are being used a lot longer than are being accounted for on their balance sheet. So that can artificially inflate some return on capital employed measures. And you do need to try and equalize or normalize for some of these things when comparing different telecom operator groups.
And what about the free cash flow measure? What are the disadvantages of that?
Yeah, so free cash flow and ultimately a majority of how businesses on public markets are assessed in terms of their value is their ability to generate free cash flow. I think one of the issues with that is you then start to get into the reverse situation, which is as you're having to deploy potentially quite expensive infrastructure, which could generate a huge amount of value in the long term or medium term, that's not necessarily accounted for in some free cash flow measures, depending on how you define it. And therefore, in a particular given year, it can start to make a telecom operator appear unprofitable from a cash perspective when actually it's making some very sensible infrastructure investment decisions.
So again, they could be change their decisions because of the short-term requirements, even though it's a long-term makes sense.
Exactly.
We've really been talking mostly about business divisions and the move into IT services and security, managed services, that sort of thing. But it strikes me that some of this is needed by operators anyhow, given that the structure of the investment is changing. The CapEx was 20% of revenue, sometimes above 20% of revenue, gradually falling over time. Now 5G networks are built out, fiber networks often largely built out as well. So CapEx is falling. So do you think we'll see, not just for business divisions, but more generally, operators look at these other measures and put more focus on these measures?
Yeah, I think so. And I think potentially fundamentally, even investors and analysts will start to reassess some of the metrics they're using to measure success or otherwise of some of these operators, because like you say, the fundamental nature of some of these groups is changing as infrastructure deployment slows down in some instances. And therefore, they become more comparable with some other service-led businesses that are more infrastructure and CapEx light. So you do naturally need to start assessing different measures or looking at different measures when you're comparing across different subsectors within the broader telecom industry.
Yeah, makes sense. So it might make sense to do it for the business divisions, but also for the broader business of a telecoms operator.
Yeah, absolutely.
Okay, great. Well, that's been really interesting. Thank you, Michaela. Thank you, Harmeet. If you'd like to receive future episodes, please subscribe to the Analysys Mason podcast. We also welcome any comments, feedback, and reviews. Thank you for listening.